Okay, so topic today is your tangible non-current asset. Actually, we call it IAS 16, property, plant and equipment. In short, it is called PPE. Then we have got very much related topic, which is IAS 40, investment property. And then we do have IAS 23, borrowing cost. And actually, there should be another related standard also, which is IAS 37, provisions, because that will also be used somehow. So this is very, how to say, very important standard, PPE. Assets, usually when you see any business, so the major portion of, in most businesses, I wouldn't call it that all businesses, but in most businesses, you would see tangible non-current assets occupying a very big place on your balance sheet, on your statement of financial position. So very important from real life point of view, as well as from exam point of view, because in exam, you cannot imagine your exam coming up. I mean, if you are taking any IFRS exam, whether it is F7 level, SBR level, DIPIFR level, any level, you can't imagine exam coming in without PPE. Yes, of course, the type of questions and the depth of questions, the complexity of questions, that could be a different level, but concept would be there. What we need to understand when the summary of this particular, let me see if I have the summary here on screen of this chapter. So this is like PPE. We will talk about the definition of this asset. We'll talk about the recognition criteria. Then you have the measurement and recognition, which is called initial measurement. Then you have measurement after recognition, which is called subsequent measurement, which means that measurement on the reporting date, end of the year. We will talk about the depreciation principles, the methods of depreciation. We will also speak about revaluation of non-current assets. And then the revaluation, where should it go? It should go to, I mean, the OCI or PNL, etc. So this is what we are going to talk about your IAS 16. Of course, a very much related topic is IAS 40, investment property. We will discuss this also. And the borrowing cost, it also becomes part of this particular chapter, because this standard is also related to IAS 16 somehow. So coming back to the topic, if we see the same thing, what we are going to discuss, define and compute the initial measurement of a non-current asset, including self-constructed and borrowing cost assets. Then you have subsequent expenditure that may be capitalized, distinguish between capital and revenue items, because we know that assets, these PPE, property, plant and equipment, sometimes you call them fixed assets, sometimes you call them non-current assets. In essence, these are the assets which you are going to use for a longer period of time, and the benefit will continue to flow in for a period of more than 1 year. So when you expect to use them for a longer period of time, definitely you need to spend some money on them after initial acquisition. So that amount of money or that expenditure which you will spend on them, some of that would be considered as repair and maintenance cost, and that should go to your operating expenses, and some of that expenditure will be capitalized. Capitalized means that it should go to the balance sheet, it should become part of the non-current asset. So we need to understand that distinction, because it is very common treatment that you have purchased an asset, maybe some vehicle, maybe some piece of plant and equipment, and then after 6 months or 1 year or 2 years, you spend some money on that asset. So what is the correct treatment of that additional expenditure? Should we take to that additional expenditure to your P&L as an operating expense, or should we capitalize it? So that's an important understanding. Discuss the requirements of relevant accounting standards in relation to revaluation of non-current assets. We'll discuss about revaluation, and when we talk about revaluation, which is upward. When we say revaluation, generally we think about upward revaluation, okay? Increase in the value of asset. Of course, downward revaluation is called impairment, which is loss in the value of an asset. And for that, we have a separate standard called IAS 36 impairment that will come later. Then account for revaluation. So if you make any revaluation, how do you treat it? And then disposal gains and losses. Sometimes you sell the non-current asset, you make gains and you make losses. How to calculate the gains and losses and how to treat the gains and losses. So this is also our area of concern. Then we need to see the depreciation method and how to calculate depreciation. Then discuss why the treatment of investment properties should differ from other properties. So investment property, we need to discuss IAS 40. That is going to be a different standard. And investment property treatment, accounting treatment for IAS 40 investment property. So this is like a quick summary of what we are planning to do today. Quite a lot of work, but very interesting and very important. So first we start with the definition of this, PPE, property, plant and equipment are tangible items. So first thing you understand that these are tangible. These are held by an entity for use in the production or supply of goods or services, for rental to others, if the rental is your business, or for administrative purposes. I should remove this thing rental to others for a while. I will explain you why. These are expected to be used during more than one accounting period. Now, first of all, we talk about the definition of an asset. We say that an asset is a resource which is controlled by an entity and which brings future economic benefit. Okay, so you have control over it and it brings you future economic benefit. And if the benefit continues for a period of more than 1 year, of course, we call it non-current asset. So these are tangible non-current assets. Now, let me just first of all very quickly differentiate between IAS 16 and IAS 40. Okay, and then we will discuss it in more detail, but let me just first make the difference so that you understand what we are talking about. Let's suppose that this is one building, and on that building there are different floors. Okay, and you've got two offices. You've got one office here which is probably on the 7th floor, and probably you've got another office which is maybe on the 4th floor. I don't know. Okay, so I ask you, what do you do with this office? Now you have a consulting company, probably you have a freight forwarding company, whatever. You say this is my office and I operate from here. So your company name is ABC Trading Company, whatever. So ABC Trading Company, for which you prepare the financial statements. So ABC Trading Company is the owner of this thing, and ABC Trading Company runs its activities from this office on the 7th floor. So the 7th floor office is actually being treated as property, plant and equipment, which is IAS 16. To be classified under IAS 16, it is important that the asset is under your ownership or under your control, and you use it. The word is that you use it in the production or supply of goods or services or for administrative purposes. So you are using this office for yourself, for your business. And then I ask you that you've got this another office as well, which is on this 4th floor. Are you operating from there as well? And you said, no, I'm not operating from there. This office I purchased because we had surplus cash in the bank, and we thought that maybe we can give it for rent, or we can keep it there for capital gains. Capital gain means that in future, if the price goes up, maybe we will get some benefit. So this office on the 4th floor, you are actually not using for ABC Trading Company's activities, correct? So this is also owned by ABC Trading Company. ABC Trading Company has got two offices, one on the 7th, one on the 4th. The 4th floor office, we are not using for running the activities of ABC Trading Company. We either have given it to rent to someone else, or maybe we have just kept it there, locked the door, and we are waiting for the price increase. Now, this is called IAS 40. This is your IAS 40 investment property. This is the main difference. Now, imagine that both of these offices are of the same size. Both of these offices are of the same value. So this is the 7th floor. This is the 4th floor. The 7th floor office, you purchased it for $200,000. 4th floor, you also purchased for $200,000. They both are in the same building of the same size. Maybe they both are on the same floor. It is also possible. But this will be treated under IAS 16, 7th floor, where you are doing activities. And this is treated under IAS 40, which is investment property. That is it for now. Now, what is the treatment? That I will explain you when I will teach you IAS 40. Right now, I'm doing IAS 16. So we will talk about IAS 16 only. But the purpose is to show you that there is only very little difference. That a tangible asset, and by the way, you should remember, when you talk about PPE, which is IAS 16, you might have different types of assets. It includes land and building. It includes, motor vehicles. It includes machinery, plant and machinery. It includes computer equipment. It includes furniture and fixture. So there are different types of assets under PPE. But under IAS 40, it has to be land and building. That's it. It has to be land and building. So investment property, you don't have in form of furniture. You don't have in form of plant and machinery. You don't have it in form of computer equipment. IAS 40, it has to be land and building. Are we clear until here?
Yes.
Okay.
Yes.
Now, if I talk about now IAS 16, which is property, plant and equipment, and like I said that it might have land, building, machinery, furniture and fixture, computer equipment, motor vehicles, all of them. The idea is that you are using it in the business for the production of goods and services, or you are using it for administrative purposes, but it is being used. It is being used. So when you bring it in, and it is expected, it is probable that it will give you future economic benefits. Not profits, but benefits. In previous session, we discussed benefit means inflow of economic benefit, inflow of economic resources. The first thing, logically speaking, when you become the owner of an asset, and by the way, assets, the assets under the standard, you can do two things to assets. How you become owner of asset? Either it is called acquisition. Acquisition means that you have purchased the asset which is ready for use. Probably ready for use, probably minor adjustments, and then ready for use. The second is called self-constructed assets. Okay, two things we talk about. Acquisition means that there is an apartment, there is a building, there is a house, there is a flat, you go there, you buy it. Self-constructed means that you constructed it by yourself. You purchased a piece of land and then you construct it. So once you become the owner of that asset and you need to book it, you need to add it into your books. The important thing is that you need to, first thing is that you need to measure it. How much is the cost? So I'm not talking about acquisition. Right now, I'm not speaking about self-construction because in self-construction, of course, you will construct the asset in a period of 6 months, and every time you will purchase or make some expenses on the assets, you will make it debit, asset, credit, cash, bank, whatever. So I'm not talking about self-construction at the moment. I'm talking about acquisition. So as soon as you acquire the asset, you need to measure it. And that is what you call it initial measurement. Initial measurement means that first time when the asset enters your books, and you need to calculate the cost. And you should remember that cost is a bigger thing than the purchase price in most cases. In most cases, because purchase price is the price of the asset itself, but cost is all those expenses which you incurred to bring the asset to present condition and location. Let me speak the word, the definition. We say that cost of an asset, it includes the purchase price plus any other expenses which are incurred to bring the asset to present condition and location. To present condition and location. Present location means transportation inward and any other expenses which are related to that. Condition means, in working condition, in up and running condition, so installation cost, etc., etc. So let's suppose that you purchase an asset from Germany for a piece of equipment for $100,000. Then you bring it to your country, and so this is the purchase price. Then you pay the transportation cost for 5K, this should be added. Then you bring it out and you pay the customs duty for, I don't know, 5K, this should be added. Then you pay VAT, maybe, 15K, should we add it or not? That is a question. Then you pay the installation of, 10K, it should be added. VAT is under question because you know that if your business can recover the VAT, if you can recover the VAT, then it is not added because ultimately you will recover it. It is not your cost. But if the VAT is not recoverable, if the VAT is not recoverable and you have paid it, but you cannot recover it, then you should add it as part of the cost. So VAT, you always need to see, can I recover it or not? If it is recoverable, do not add. If it is non-recoverable, then you must add. And installation cost, plus there are some other preparation cost or something like this. Site preparation, maybe you do. I give you an example. In 2014, we purchased some equipment which was for 16 million. The purchase price was 16 million, but actually it went into my books for 19.8 million. 3.8 million I spent on installation and site preparation, the platform on which that asset had to be, because it was a very heavy part of equipment. So we need to put some concrete platform on which we had to put that thing. That concrete platform was not needed. So that I put it as part of this, the whole setup. So it depends on what type of other expenses you incur. The idea is that you need to make sure that all the expenses which are directly related to the preparation of that asset until it becomes ready for use, those should be added. And once these are added, then you say this is the cost of my asset. Directly attributable costs are cost of testing. It becomes inside professional fees, installation, assembly cost, initial delivery and handling cost, cost of site preparation, etc. But there are some other costs as well. In initial cost of the asset, initial cost asset, you should be adding estimated cost of dismantling and removing the asset. This is IAS 37. We will discuss it in more detail when we will do IAS 37, but you should remember that sometimes the asset which you are installing there, you have an obligation, you have a liability to remove it from that location after a certain period of time, because the property, the land is rented, and you are bringing in something, and after some time you have to remove it. So the removal, dismantling cost must also be added. I give you a very simple example. Let's suppose that there is some, some particular event, I don't know, some fair or some event, and there are people who put their stalls for a period of 10 days or 1 week, just temporary stalls, because there is some event which is happening, probably a new year or something like this. So they created some temporary stalls. So this one temporary stall, it cost me, I don't know, $3,000. Then to bring in the stall, I paid $1,000 and install it. And then after 1 week's time, because it's a temporary place which has been given to me, after 1 week time, I need to take it away from here, because this place, this square or this park or this garden, whatever it is, This stall cannot remain here. So I need to take it away. And the removal of that cost me 500. So if somebody asked me, what is the cost of this stall? I would say 4,500, 3,000, the cost of the stall, 1,000 bringing it in, 500 taking it away. So that 500 should be included. Now that's a very small amount, and that is an amount which I have to pay after 1 week. So I put 500, but many times what happens that you make a premises, you construct a factory, you take a land on lease for 10 years. So your construction cost of the factory is, I don't know, 30 million. But then the contract says that at the end of 10 years, you have to remove it and you have to return back the land in its original condition. And we estimate that 5 million would be the cost of removal after 10 years. So we need to, this 5 million we also will have to spend, because if we do not agree to remove this premises, this factory from here, they would not have given us the land. You know, the usage of this factory and the getting benefit of this factory was only possible because you agreed to remove it. So this also is your obligation. So you find out its present value. We will discuss it in detail when we do IAS 37, but you find out the present value because 5 million would be an expense after 10 years. We are standing here in year 0. So we find out the present value of 5 million. Let's suppose it is 1 million. This 5 million is actually 1 million in today's terms. So we say that the total cost is 31 million, and then 31 million will be depreciated. So within your asset, you not only include the installation, you also include deinstallation or dismantling or removing. This is important to remember.
So one question. So this is an accrue. The cost must be accrued at the beginning of the asset recognition. Am I right in saying
yes,
that?
we must add it here. In the very beginning, I would say the asset cost is 31 million.
Yes. So if it's a 10 years assets, all the 10 years, this cost should, as you said, as a present value. Maybe you cover it later, but
it is 31 million. I will have now 31 million depreciated over 10 years. Every year, I'm going to depreciate 3.1 million. This 1 million, I should add it in my initial cost.
All right. So the 10 years, this accrual would remain in the books as an dismantling cost.
It is actually not remain like this because this 1 million, I have to increase it ultimately to make it 5 million. And that is the unwinding process we will discuss in IAS 37. Because in my books, at the end of 10 year, this 1 million actually should be inflated to become 5 million so that I can pay off my liability. But today I only include 1 million, which is the present value. I'll explain this process when we will do IAS 37.
Fine.
That how this 1 million will become 5. That's something we will discuss later. But what you need to remember that within the cost of the asset, you need to add the present value of your future obligation. The present value is 1 million. My future obligation is 5, but 5 is after 10 years. In terms of today, it is only 1. I discount it. So this is the discounted value. And I would say my total asset is 31 million. Clear? Now, so we said that the cost of the asset, which will include the purchase price plus transportation, okay, plus installation, plus any kind of duties or taxes, whatever, customs, whatever. Plus it will include my dismantling cost must be added. The present value of dismantling cost, very important, because dismantling is 5 million, but I'm not going to add 5. 5 is after 10 years, not today. In terms of today, it is only 1. So I will be adding 1 million. And then if it is a self-constructed asset, like I said before, self-constructed asset. If it is a self-constructed asset, and for the purpose of this preparation of this asset, you take a loan. So any interest on this loan should also be capitalized. Generally speaking, when you take a bank loan and you pay interest, interest is an operating expense. interest, it goes to your income statement as finance cost for normal purposes. But if you take a loan, because we had to build a factory which cost 30 million, and we didn't have 30 million, we had only 10, and 20 million we took a loan. So this 20 million loan, we never needed that thing. This 20 million loan was purely taken to self-construct the asset. So in that case, the interest on this asset, it is called borrowing cost, and we will discuss this standard separately, and I will explain the details. But here I'm only telling you that if you pay interest on any self-constructed eligible qualified assets we call them, the interest which you pay, that interest will be added to the cost of the asset. So interest cost will also be added. Now, remember, you may pay interest cost on acquired assets, but that you will not do. For example, if I go to a bank and I purchase a house on mortgage, or I purchase a vehicle on mortgage. Now, it is not a self-constructed asset. So when you take a car on credit from a bank, you definitely pay interest, but that interest cannot be capitalized because that interest was not paid on an eligible asset, qualified asset. A qualified asset has to be a self-constructed asset. If you purchase a ready-made asset, a ready-to-use asset, then interest cannot be added, because interest can only be added during the development or the creation process of the asset. If you are developing the asset, if you are creating the asset, so that period, which is the creation period, only interest during this period you can add. But when you purchase a ready-made asset, it is already ready to use. You are going to use it. When you will pay, you will use it, you will earn some revenue, and from that revenue, you can charge off expenses on interest. Both will go to the income statement. Because if I purchase a ready-to-use asset, I will start getting benefit immediately. So the benefits will go to my P&L, and interest will also go to my P&L. That's it on ready-to-use assets. But for self-constructed assets, you are not, this is the creation period. You are not using the asset. You are only developing it. During this period, there is no benefit. So what do I do with the interest? Interest is added here. So anyways, I make a summary that initial cost will include all the expenses which are directly related to the acquisition, preparation of the asset, to make it up and running condition, to make it in ready to use condition. Plus you will add the dismantling cost, plus you will add the finance cost, which is IAS 23, which you call borrowing cost, the interest, only the interest for that period during which you are creating the asset, not after that. Any question you have? For example, I'll just give you, I'm going to discuss it in detail later on. It's a separate standard. But let me tell you, we took this 20 million loan, okay? The asset which we are making has a 10 years life. So for first 1 year, this is the development period where you are creating the asset. And this is where the asset is being used, okay? So only this period is how many months? This maybe is 8 months, okay? And this is 10 years. So this 8 months, only this period interest will be added. This will be capitalized. This will go to the balance sheet, 8 months. But once the asset is ready and you start using it, it is ready. Not start using it is not a condition. You use it or don't use it, doesn't matter. But asset is ready. When asset becomes ready, then you cannot capitalize. Then this interest will go to your P&L. That's all. So this is about our initial measurement at recognition. So once the asset you have booked up in your book, the double entry is debit, non-current asset, credit cash, credit bank, whatever. So asset, it goes into the balance sheet. And this is called initial measurement at the date of acquisition. And then naturally speaking, you start using the asset. You start using the asset. And while using the asset, because you are going to use the asset for longer period of time because it is non-current asset and we expect to use it for 2 year, 3 year, 5 year, 10 year, whatever, it is possible that you may spend subsequent expenditure on that. It is not possible, it is quite usual. And I'm sure that it happens always, that you will have to spend extra money on this asset. Now, this extra money which you spend on this asset, it will be categorized into two categories. So this subsequent expenditure, either it is called OPEX, which is operating expenditure, and it should go to your P&L, or you can call it CAPEX, which is called capital expenditure, CAPEX. And CAPEX, we take it into statement of financial position, balance sheet. So what is the differentiating? Now that's a very technical thing because a lot of students will face this thing. You know, somebody calls me and says, you know, sir, we had this water tank and there is a huge lid on the top and we had to replace the lid, $3,000, $2,000. What do I do with that? I paid $2,000 for, I had some underground tank and there was a metal lid. That lid was eroded or, you know, broken. We had to replace the lid. We paid $2,000. So this lid, am I going to charge it to CAPEX or OPEX? Because these two things, the decision between these two is going to change your profitability. Because if you say it is OPEX, you take it to P&L and profit goes down. If you call it CAPEX, it does not impact your profitability. In fact, you take it to the balance sheet and assets go up. So there is a, you know, how to say, a significant impact on which comes with your decision. So that's an important decision. The rule which you should remember, because there could be 1 million situations. And like I said, that IFRS, the beauty of IFRS is that it gives you some principles, some guidance, and then it leaves it to you on your judgment. You have to decide what to do in a different situation. The rule is, you should remember, if that subsequent expenditure, it increases the revenue generation capacity. If it increases the capacity to bring more economic benefits, that is capital expenditure. You will only make it CAPEX if it increases or enhances the economic benefit from that asset. Whatever is the economic benefit from that asset, if it is increased by that expenditure, it is capital expenditure. Otherwise, you call it repair and maintenance. Maintenance, the word maintenance, what does that mean, maintenance? Maintenance means maintain. If I'm spending some money and it maintains the asset, it is not increasing the capacity of asset, it is this money is spent only to maintain the capacity of the asset, then it is repair and maintenance. For example, if you have got, I'll start with some smaller examples, smaller scenarios, and then move on to slightly difficult ones. You maintenance expenditures, like you have a building, so you change some door locks, maybe you're, you know, whitewash the building, paint the building, paint my room, change the wallpapers of my room. All these are maintenance expenditure, repair and maintenance. If I change the wallpaper of this room, it does not increase the earning capacity of this room. If I change, you know, some minor repairs on my cars, it does not change the earning capacity of my car. But if there is my car, which is like a transport vehicle, and I put some metal rack on the top, okay? Now, this metal rack on the top, it increases the capacity of transporting the goods. And I'm going to start earning more money because of that. Then this I would take as capital expenditure. But if I'm changing the tires of this car, that does not changes or increases or enhancing my earning capacity, I will take it as OPEX. Now, it is possible that your judgment might be different than someone else's judgment. And it is also possible that your own judgment is different in two different situations. I give you an example. Now, that is something which is just for the sake of understanding. There are two companies. One company is called Vertex Learning Solutions. Vertex Learning Solution has a car, an office vehicle, and that car is used for admin purposes, like we use it for going to bank, we use it for purchasing some everyday office supplies. So that's an office car, which is used in general administrative purposes of office. Then what I see that this car is now, its paint is not good. It is old car. Interior is not really good. So what I do, I spend $2,000 on, changing the interior, some seat covers or some other interiors, and I painted the car and I put it like this, $2,000 or maybe $1,000. What do I put that $1,000? Where do I put that? It goes to my repair and maintenance, because this particular car is not, because we are a training provider, it is not going to enhance the earning capacity of this thing, of my business. I'll take it to my repair and maintenance. I wouldn't capitalize it. But if I now leave the job from this VLS and I go to another company, and the other company name is Avis Rent a Car. And when I go to Avis Rent a Car, I spot that there is one car which we are generally giving out on rent. It has been given to the customers. And this car also needed paint, the same job. It also needs the same job. And I spent $1,000 here again. Now in Avis, I am the same guy. 3 months have passed. Here I'm going to treat this $1,000 as capex, because after spending the $1,000, I'm going to give this car to my customer at a higher rate. Before, this car looked bad condition, in bad condition, or maybe an old car, it was going for $50 per day. But once I improved the condition of this car, I started giving it for $70 per day. So you should consider that this is, there a lot of, you will face thousands of different scenarios, and every time you will have to make your judgment, and you need to see that, am I increasing or enhancing the capacity or not? If the expense is material, and if it does increase the earning capacity of that asset, then make it capex. Now let me give you one more example here. Okay. Sometimes, now I've got a car which has a life of 5 years, and 5 years have passed, and I spent $1,000 on its engine overhaul. Okay, engine overhaul. There is a major overhaul of engine, and I spent $1,000. Now here, what do we say? Students sometimes they say that, oh, this $1,000 is repair and maintenance, and that goes to P&L, because when you overhaul the engine, you are maintaining the same capacity. The car's income generation capacity is not increasing, because it is the same engine which was broken down, and you just repaired the same engine. So take it to repair and maintenance. My answer is take it to capex. Take it to capex. Why? Because income generation capacity is not related to only, before it was able to generate you $1,000 each or $2,000 each for a period of 5 years. So the total earning capacity was 10K. But after this engine repair, you still are getting 2,000. It is not giving more, but it is going to give it for 7 years. The life has been extended. So the total capacity is 14K, and therefore this 1,000 has increased your earning capacity. So increasing the earning capacity does not mean that within one period it should increase. Over the life of the asset, you should consider. The life of the asset from 5 years, it has gone to 7 years. So you are going to earn more money. So this 1,000 can be taken as your capex. So these are, we call it subsequent expenditure. We always get stuck with that. Oh, we purchased a hard disk. Should we capitalize it or should we charge it to the P&L? We call it charge it to the P&L. Charge it to the P&L means that it is subsequent expenditure can go to P&L, which means OPEX, or it can go to SOFP, which means CAPEX, okay? Now, if you remember my previous session in which I was explaining you SOCI, and in which I was telling you that managers, they always want higher profitability. They remember that PBIT line, profit before interest and taxes, and managers' performance is measured there. What do you think? What is the tendency of manager? What managers would like to do? We spent $500 on something, and we have to decide, should it go to P&L or should it go to SOFP? What do you think? What is the tendency? What managers like to do? Do you think managers would take it to P&L or to SOFP? What is the general inclination?
SOFP, sir.
Managers would try to take it to SOFP, because if they take it to 500 to P&L, their profit goes down, which nobody likes. So this is always a decision point where you need to think that managers have a tendency of taking most of the expense items into SOFP, and in between IFRS is standing. In between IFRS is there. And remember always, capitalization, we call it. We call it capitalization. Capitalization means, taking an asset to the balance sheet. Capitalization criteria are always tough. IFRS has a tendency of taking it to P&L. By default, IFRS wants maximum expenditure should come to P&L. If you see the standards, and we will see borrowing cost, IAS 23, we will see IAS 37 provisions, or even IAS 16, all of the standards which you will see, or even IAS 38, we call it capitalization. The capitalization criteria is always tough, because IFRS knows that managers will try to take it to SOFP so that P&L is not hit, so that profitability is not affected. So you have to be very careful. So if you are ever in a situation where you are in a doubt and you are not able to take a decision and the situation looks 50-50, you should be taking it to P&L so that you are following the principle of conservatism. When you take it to P&L, you are actually following the prudence concept. You are being prudent. Prudent means what? Prudent means that income is shown at a lower and assets are shown at lower level. Because when you take it to P&L, what you are doing, you are actually, profit is going down. I'm sorry for my handwriting. When you take it to P&L, what is happening? Profit is down and your assets are also down. But when you take it to SOFP, profit is enhanced, increased, and assets are also increased. This is not a prudent approach. This is not a conservative approach. Conservative approach is this one. So if you are ever under doubt what to do in real life, of course, we have to prepare financials on conservative approach, and the conservative approach says take it to the P&L.